low risk in the stock market? Index funds are the way to go. It's kind of like getting somebody to invest your money for you without the price of an actual investor. It's giving Dora, but it's okay because we're exploring the stock market. Welcome back to my channel. My name is Ure, but I also go by Chimso. If you're new here, I talk about being young and becoming financially free. I'm a 19-year-old college student on the way to being financially free, and I'm just here to help anybody else younger or older than me that is on the journey as well. If you're returning, hey guys, I missed you. As you all know, we are on the journey to reclaiming our childhood through financial freedom and financial literacy. So if you're ready, let's hop into this video. A few disclaimers. Obviously you can see a few things have changed. My hair, my setting. I'm no longer at college. I am back home for the summer, and hopefully for a while this will be my setting and where I'll be shooting my videos. My mom is trying to set up a studio for like her own personal reasons for her business, so maybe I'll switch over there. And then obviously my hair, I look different. If you didn't know, I'm black, so black girls' hair changes all the time. If you're not black, you're just gonna have to get used to it. My hair might be like this today, and in the next video it might be different. It's just how it works. I could have this for 3 months, I could have it for 3 days. It's how it works. So don't be shocked by my appearance. It's just gonna be changing all the time because that's just how we deal with it. Today we'll be talking about index funds, what they are, different types of index funds, what I'm personally doing with index funds, and just give you information coming from a new investor, since you're probably in the same place that I am. So let's go ahead and get into this video. Okay, so I have my notes right here, so don't mind me if I'm like looking down at my notes to figure out what exactly to say. So I guess we can start off with what exactly is an index fund. Two parts of an index fund: index and then a fund. A fund is basically a pool of money where a lot of investors come together and put in money, and then that pool is then used to invest in various companies. You probably heard of mutual funds, which that one is directly managed by an investor, and then there's also index funds like what I'm talking about now. These ones track stock exchanges, and then there's also exchange traded funds, which is very similar to index funds, except it has a few differences, like when you can trade, what exactly is being invested in, and things like that. So for index funds, they are funds, so a pool of money that a lot of investors put in that track the different stock indexes. Now, to understand an index fund, you need to understand a stock index. What is a stock index? A stock index is basically, stock indexes track specific companies or specific markets within the economy to give a rough estimate or an overview of how the market is doing. Different indexes track different things. There are a few different types of indexes. I'm going to name a few of them and then explain exactly what they track. If you hear background noise, somebody is mowing the lawn next door, so please ignore that. Different types of indexes. The most famous ones are the S&P 500, the Dow Jones, NASDAQ, and then the New York Stock Exchange Composite. There we go. The S&P 500, if you haven't heard of anything else, you've probably heard of the S&P 500. It is a stock index that tracks the top 500 companies within the US. I don't know if that's in terms of their size or in terms of their profit. That's what the S&P 500 is. They track the top 500 companies. Dow Jones tracks 30 big companies within the United States. It's the Dow Jones Industrial Composite. I think they track more industrial companies. That's what big companies were like back in the day, but obviously with the rise of technology, things are changing a little bit, but that's what Dow Jones tracks. The NASDAQ Composite tracks all of the companies within the NASDAQ exchange. So, well, not all of them, almost all of them within the NASDAQ exchange. So I think that one gives a broader view of the market versus Dow Jones and S&P 500, because those track top companies, while NASDAQ tracks all the companies that it has within its exchange. The New York Stock Exchange Composite, it's the same thing as NASDAQ. The New York Stock Exchange obviously is an exchange where companies are traded, and then the New York Stock Exchange Composite tracks companies within its exchange. It tracks specifically common stock. So when you buy stocks, you're either common stock or preferred stock. In common stock, you have voting rights within the company, and then in preferred stock, you don't have voting rights. And then there's also a thing with like how earnings work, but that's the main difference. You don't necessarily need to know that in order to invest in index funds, but that's what the New York Stock Exchange composite tracks. Usually the growth of an index fund follows the specific stock index that it is following. So let's say you have a index fund that tracks the S&P 500. The growth of that index fund will generally follow the growth of the S&P 500, or same thing with Dow Jones. There's also ones that track like specific sectors in the market, some that try and even beat those stock exchanges, but that's basically what it is. It's usually tracking a specific part of the market, usually a stock index. Why I think it is important to invest in index funds is because three main reasons are diversification, low risk, and the growth of them. So normally when you get into the stock market, a lot of people, like when they're new, they don't normally like know about index funds or things like that, or that you can pay other investors to invest your money for you. They generally try and do it on your own, especially if you're young and you don't have a lot of money. It would cost money to pay an investor to invest for you. So normally you try and go in, learn as much about stocks as you can, and try and invest the money on your own. With index funds, you get diversification, which is basically, if you've ever heard of don't put all your eggs in one basket, this is basically what that means. You want to spread your investments around the stock market in as many different sectors as you can. So just in case one doesn't grow, you have another one that you're in that will get larger with time. Also, low risk. In the stock market, there are certain companies that go up and down all the time. The stock market in general is going up and down all the time. Even index funds are going up and down all the time. But with index funds, you're in a fund that is generally spread out throughout the market. So it's the same thing as if one goes down, another one is probably going up, which means less risk, as in you're probably losing less money overall, or you're growing more than if you were picking stocks on your own. With growth, you tend to grow more in index funds because they are following stock indexes, not exchanges. And the stock market tends to go up. So as the stock market goes up, these indexes generally also tend to go up. And as these indexes go up, index funds as well go up. So you tend to go up over time. I also want to say, when you're investing in index funds, don't think of it as a short-term thing unless they're like trying to beat the market or anything. Think of index funds as a long-term thing, because in the long run, the stock market and the economy tends to grow, whereas in the short run, it can fall, as we saw last year with the panoramic. Yeah. Also, when you're in an index fund, you're putting in less time to be in multiple companies, whereas if you were picking companies on your own, you're gonna have to like do your own research on which companies you should pick. Are they growing now? How long do you want to be in there? And also, you're putting in less money because you don't have to buy into a lot of different stocks. You just pay one price for an index, and then you're in a large portion of the market. Growth, diversification, and low risk are very important when you're starting to invest. These are three main things that you want to focus on whenever you're investing, whether it's in index funds or you're picking stocks by yourself, which industries to get in. These are three key factors that you want to focus on when you're investing. So now I want to talk about the different types of index funds. So like I said earlier, index funds generally tend to track a stock index, but there are different types of them. Not all of them track a stock index. Some of them, like I said earlier, try and beat the market. Some of them focus in certain sectors and things like that. So we can go ahead and go into what the different types of index funds are. A broad market index fund is basically a fund that is in a lot of different companies across the stock market, across the economy. So you're in a lot of different sectors and a lot of different industries and a lot of different companies, big, small, medium size. It's broad. It covers almost everything. And like I said, generally the economy tends to go up, the stock market tends to go up in the long run. So if you're in a broad market index fund, you're generally gonna gain money over time because diversification. There are sector index funds, and these ones focus on specific sectors. So it could be clothing, technology, cars, food education, beauty, like hair. So if that industry is growing, then you would invest in an index fund that tracks that. There's also dividend focused index funds. A dividend is a certain amount or percentage that a company gives to its investors throughout the year. So you can get it annually, biannually, every quarter. That's all dependent on the company. And then you either get a fixed amount or a fixed percentage, and it's all based on how much you have within the stock. So some companies that do this are Pfizer does it, I think Apple does it. There are other companies, I don't remember them off the top of my head. Dividend focused index funds, they invest in companies that are sure to give you money, because you're definitely going to be getting a dividend, which means that you're definitely going to be getting money out of them. There's also bond index funds. So a bond is a loan that you give to the government, and then you get a certain amount back after a certain period of time. It can be a lot of work trying to find bonds and invest in them. So there are index funds that do this investing for you. That way you're able to get into the bond market. For all index funds in general, you're basically having someone invest your money for you without having to pay the price of an actual investor. Basically, it's great, honestly. I want to include earnings-based index funds. I probably won't invest in earnings-based index funds because I feel like they're speculative, but I'm just including this in there because if you're having conversations with people, they might bring this up. Earnings-based index fund tracks companies based on their earnings, and then there's two types: growth earning-based index funds and then value earnings-based index funds. Growth earnings-based index funds track companies that they think their growth will beat the market. Value-based index funds track companies whose earnings are higher than what their value is within the stock market. The reason why I said this is speculative, mainly for growth-based index funds, is because they're predicting that the company is going to grow more than the stock market itself. It's called beating the market. This is what a lot of investors themselves try to do when they invest your money for you. And it can be very risky because they can be wrong, and then the price of the index fund goes down, which is why I don't like this. I like things that are more secure, less risk, especially if you're investing in index funds. It's better to invest in index funds that have less risk because that is a more sure way of getting your money in the long run. And then if you want to take more risk, you can do that with other money. But I personally would say that index funds are better for low risk, long-term investments. Now, there are a lot of companies out there that you can use to invest in index funds. If you're in a broker or you have your brokerage account, you can access these index funds through there, or some of them you have to have an account with these specific companies to invest in their index funds. A few of them are Vanguard, SPY, Fidelity, and Schwab. There's obviously a lot of financial companies out there that are doing index funds and give you the opportunity to invest in them. They each have their own perks and their own specialties, and I will put links down in the description box if you want to do more research on them. If you search up in Robinhood, Vanguard, a whole bunch of index funds, ETFs, and different things like that will show up, and then you can invest in those. I think for Schwab, you have to invest in them through their company. If you search up SPY or Fidelity within whichever brokerage you're using, I'm just saying Robinhood because that's what I use, but if you search it up within Robinhood, you'll be able to see the different types of index funds. You can see what they track, like which indexes they're tracking, or which market or sector they're tracking, or what it's based on, which is why I gave you a few types of index funds earlier. So when you're going to look for something to invest in, you know what they're tracking. Okay, now I want to talk about what I'm doing with index funds currently. I just want to start off by saying, if you haven't watched my other video on like losing money in the stock market and like fear of investing, just go and watch it. It's a brief video. I've been thinking about investing in index funds for about a month now. I haven't invested because of that, because I'm like trying to teach myself to not be scared of losing money in the stock market. But there are a few of them that I have been watching for the past month, and I'm just gonna share them with you. VOO, that's what the name is if you search it up in your brokerage account. This is Vanguard, and they track the S&P 500. Another one that I'm watching that tracks the S&P 500 is the SPY one. So if you search up SPDR, it will come up. Another Vanguard one that I'm looking at is VT, which is Vanguard Total World. I haven't exactly done the research on like what Total World means, but I'm guessing it's an international one. So they track within the US and then also international markets as well. The other one that I am looking at right now is ONEQ, one of Fidelity's NASDAQ index funds. So obviously with the S&P 500 ones, they track the S&P 500 like I said, and with the NASDAQ one, they track the NASDAQ composite. As I'm going into investing in index funds, these are a few of the strategies that I want to use. Obviously everybody's different. Do your own research as always. I'm not an expert. This is just what I personally want to do. I want to be invested in index funds that are in the different stock indices. So I want at least one in S&P 500, NASDAQ, Dow Jones, and the New York Stock Exchange Index. I also want one in the sectors that I'm interested in or that I think are going to get larger over time. The two main ones that I'm focused on right now is technology and electric cars. Obviously, like as I get more into it and I learn more, I'm going to be coming up with more lists of things that I want to be invested in. Also, if there are companies out there that are doing like space travel, because I really think that's going to be a big thing in the long run. As you can see, I'm more like technology oriented when it comes to index funds because I really think those markets are going to be growing a lot as the world develops. I didn't mention this earlier, but there are international index funds and they focus on the international market, as the ones I mentioned earlier focus more on the United States market. So I would also be interested in investing in index funds that track emerging markets like China and India, or some African countries like Nigeria. I'm Nigerian, so personal interest in that. Different things like that, you know. There's a lot of different ways that you can invest in the stock market. Everybody can have their own strategy or things that they're interested in investing in, or ways that they go into, how long you stay in there. There's a lot of different ways to do it. I just wanted to give you guys this video on basic information that you might need when you're going to invest in the stock market. A quick recap: I talked about what an index fund is and then broke down what the most famous stock indexes are. I also talked about some different types of index funds and then a few companies that you can use to go ahead and invest in index funds. I talked about what I'm trying to do with index funds, and you guys can go ahead and put in the comments what you're thinking about index funds. If you've never heard about index funds, something that you liked about what I said, why like I think people should be in index funds if they're thinking about becoming an investor, or some tips that you have for me, you know, something that I might not know. You can go ahead and put that in the comments. Go ahead and like, comment, and subscribe if you haven't already to this video. Obviously, it helps me a lot as a growing YouTuber, and also I just like to engage with you guys and see what you all like and what you all think. Thank you for watching this video. I hope you guys got a lot of information, and I hope you are doing well on your own personal financial freedom and financial literacy journeys. Like I said before, go ahead, like, comment, and subscribe. Anything that you would like to see me do, you can go ahead and put that in the comments. But that is it for this video, and I will talk to you guys later. Bye.